Hello, good afternoon and good evening. My name is Dan Smith and I'm Head of Research at AMT. So I'm going to be talking to you today for about 10 minutes about copper arbitrage and also the outlook for copper and looking at the signals that we're getting from both China and investors in terms of the arbitrages between London and US and Shanghai Futures Exchange. So in terms of what's happening with copper, what we've got here with this blue line is, this light blue line, is that we've seen that LME copper prices fell into the middle part of last year and then kind of slowly rallied into late last year, but then generally have trended down actually in through the first couple of months of this year, 2 or 3 months. And they found a floor around about $8,500 a tonne. So we do think risks are now actually skewed to the upside for copper. I think it's pretty clear that China's recovering on the back of all this kind of strong stimulus that's coming in from the government. So we saw from the credit data, for example, that UN loans were very strong in the first 2 months of this year, but there's lots of other evidence that the government is pushing pretty hard on the accelerator at this point. So one way of measuring how China's getting on is this shown by this yellow or gold line here, and this is actually the 1 month Shanghai Futures Exchange price relative to the London Metal Exchange 1 month price. And the idea of this really is that when we're down here and this arbitrage is negative, so around about minus $200 a tonne, that actually means that China is more likely to export copper because they can get a better price in London than in Shanghai, and therefore the copper market is going to be more oversupplied than you would expect otherwise. And then vice versa, when that arbitrage flips into being positive, which it has done more recently, the opposite is true, which is China's going to import more copper and exports will be kind of choked off. So this is quite an early signal that actually China is doing very well and that we should be bullish on copper. And again, when we look at some of the other fundamental data for China, we can see here we're showing the Shanghai Futures Exchange data. We can see here that actually the copper stocks have this very well established seasonal pattern. So we always get this kind of ramp up in terms of inventories around about Q1, around about March, April. But then as you can see here, as we go through the year, inventory is steadily drawn down. And this year's been no exception. Again, we had this big build up to 250,000 tonnes in about February. And then since then, we've been seeing a steady downward trend. So again, this suggests that the Chinese market is tightening and that demand is outpacing supply. And then looking ahead, of course, given these recent lines, it suggests pretty heavily we're going to see continued drawdowns in terms of SHFE stocks, and again that will be quite supportive for copper. So just to kind of reinforce that bullish story, what we've also seen in terms of utilisation rates at copper fabricators, they've actually been pushing up as well, so that's kind of final confirmation that China is indeed doing well in terms of demand. So wire rod plants were operating at 75% utilisation rate in mid-March, and that's up significantly from where we were a couple of weeks ago. And similarly on the copper tube side of things, they were up to 80% utilisation by mid-March, again up very significantly from a few weeks ago. So that's it in terms of China, which looks pretty bullish. On the other hand, we have these kind of very significant headwinds coming from global financial markets. So first of all, we had the collapse of Silicon Valley Bank, which kind of sent a ripple of fear through the banking sector and equity markets. Also, of course, the merger between Credit Suisse and UBS. But the past week or so has seen that fear kind of fading a little bit. But one of the ways that we track investor interest in copper is actually looking at this COMEX ARB. So again, this is actually the COMEX 3-month price against the LME 3-month price, shown on the right hand side, and then again we've got the LME price on the left hand side. You can see here these two have been moving kind of largely in lockstep, but more recently what we've seen is this kind of arb trending lower through most of this year, and this really reflects the fact that investors are becoming more nervous and that arbitrage between a US market and London market has been coming down. So this would make sense really, because we know that the US dominates global capital markets, but also if we look at commodities themselves, if we look at say the BCOM index, which is one of the big commodity indices, has more than $100 billion of money tracking it. So that actually has a 5% allocation to COMEX copper and a 0 allocation to LME. So again, it reinforces this idea that US flows are very important. Another way of looking at this is, the LME is also of importance, so we can also track the net speculative positions on the LME itself. And what we show here with this dark blue line is those net spec positions, and again they move very closely with the LME price. So as investors cut positions, the LME price tends to fall, and then vice versa, as net spec positions pick up, LME prices tend to go with it. The other interesting thing is there is kind of some evidence that speculators tend to move first. So we can see here that speculators were kind of cutting positions here before copper prices fell, and vice versa. Here we can see that speculative positions picked up before the copper price. So again, it doesn't always work, but generally there seems to be some sense that actually net speculative positions give us a leading indication about where copper prices are going to go next. And in terms of where we are now, so that net spec position is currently 40% of the historical range. So that means they can easily double potentially if people get very bullish. So we do see some scope for that net spec position to build from here, and also that would help to take copper prices higher as well. If we look quickly now here at aluminium, we can see that the equivalent chart here. So again, we've got the COMEX line in dark blue, and then the LME price in light blue. So again, there's a kind of tendency for when speculative positions are coming down, the ARB is coming down, and LME prices are being weighed down by that kind of lack of investor interest, or investors going from bullish to bearish. So we did see over here that actually there was a big discount on COMEX, and that was consistent with kind of weakish LME prices, but also it does reflect the fact that speculators were looking to benefit from lower aluminium prices. So it's important to recognise actually that for aluminium, COMEX is not quite as important as for copper. So in terms of outright volumes, copper, the COMEX and LME are kind of roughly equivalent, whereas in aluminium, outright volumes on the LME very much dominate and probably account for about 4 times the volume traded on COMEX. So for aluminium, the signal is not quite so important, but nevertheless we may see that becoming more significant in the future, particularly as people are kind of feeling like they want to move from the LME, away from the LME at the moment, because of a heavy dominance of Russian metal. So in terms of copper, just to summarise the story here, what we've seen is that copper prices have generally trended lower this year, but up in the past week or so, and this comes despite a backdrop of ongoing fear about the impact of rising interest rates and the consequent turmoil that's been created in global banking. So that's definitely a headwind. In terms of China, we've seen that there's a lot of reasons to think that demand is strong. The government is definitely putting a lot of money into key sectors such as the state grid, but also green energy sectors such as wind and solar. Finally, in terms of the EV sector, that's still growing, slightly weaker in terms of growth than we saw last year for sure. but growth continues despite this removal of what was quite a long-standing central government subsidy for the sector. So China is strong, but on the other hand we have these headwinds for copper from reduced risk appetite, as we saw that was kind of highlighted by the COMEX ARB, but also the cuts in net spec positions on the LME. In terms of copper supply, we haven't really spoken about that too much today, but it's worth noting that supply is ramping up, we think. We've seen a reduction in problems in Peru at places like Las Bambas. So there have been a lot of problems in terms of blocked roads and anti-government protests there, but those are generally easing. We are also seeing some more kind of structural changes coming through in terms of copper, so a big ramp up at the OT mine in Mongolia as that goes underground, but also some big mines coming through in terms of Latin America. So there's quite a lot of supply growth coming through for copper. But having said all that, we are seeing spot TCs actually coming lower, and actually that's the opposite of what we would expect if supply growth is strong. So that's again another kind of bullish signal that extra supply is being well absorbed by the smelters, and actually spot TCs are still going down. So in terms of prices, we do see more upside from prices from today. Supply and demand are both likely to grow by about 2% this year, we think. Exchange inventories we think will remain very low, and that's likely to leave the market vulnerable to significant bouts of tightness as in the weeks and months ahead. So we're bullish on copper. We see more upside for investors. We see Chinese demand improving, and overall it's quite a strong picture, we think, for the short term. So that's it from me for today. My contact details are here if you have any questions, so daniel.smith@amcgroup.com. Please do get in touch if you have any questions, and I'll be happy to help. Thanks very much.